Items are used for creating invoices and/or tracking things like inventory on the expense side. It is important to understand items and how they work before you start using your QuickBooks product. First, you must decide if you're going to use accounts receivable and/or accounts payable. Do you have to use items for both? No. You only have to use items for both when you want to track both the income and expense of the same item. For example, if you have a service that you want to invoice for and you also have a subcontractor that either performs that service or is part of that service and you want to track the gross profit margin of that item, then yes, you do want to use items to track income and expenses. If you are tracking inventory in QuickBooks, you absolutely want to use items to track both income and expenses. Anytime you create an invoice, you must have items set up or you cannot actually create the invoice. Before you set your items up in your QuickBooks product, think through and map out all of the items you would invoice for and/or want to track on the expense side. There are several item types: service, inventory, non-inventory, other charge, subtotal, group, discount, and payment. It is important to note that there are two item types that cannot be changed once set up: service and inventory. If you select inventory item as a type, it is really non-inventory. You cannot change this item type. This is why we recommend thinking through the items and mapping those out before you set them up in your QuickBooks product. The items are also tied to the chart of accounts, so understand the chart of accounts before setting up the item in your QuickBooks product. If the correct account is not chosen in the chart of accounts, then every time that item is used in either an invoice or in Enter Bills, it will appear in the incorrect income or expense account. When items are set up and used correctly, they can lead to powerful, detailed reports for both income and expenses.